Before you watch the video, do not forget to put a like and leave a motivational comment and subscribe to receive our newest videos. Central banks strive to raise interest rates to fight inflation. During a discussion on Monday, October 17 at the Central Bank of Latvia, experts will examine how this decision will affect households and businesses, and whether the Latvian economy can withstand the double impact of high inflation and higher interest rates. The expert discussion is live on LSM and you can watch it under this story. As interest rates rise, the central bank is struggling to fight inflation, which is over 20% in Latvia and other Baltic states. Kārlis Vailerts, head of the Monetary Policy Research Department at the Bank of Latvia, stressed that this is a hard pill to swallow, but necessary to prevent inflation from taking hold. It's one thing to live with inflation for a short time, because we know we'll soon be back to the low inflation rate we've had for the past 10 years, which is 2%. If the inflation has to stay, that's another story. Then there is the risk that inflation will take root, which will be taken into account in wages, but employers will be forced to finance it by increasing the price of goods and services, so inflation will pick up, Vailerts explained. Higher interest rates are a way to cool inflation and slow it down a bit. Inflation is currently not caused by the overheating economy, but by global developments, rising prices for energy and food resources, supply chain issues, Vailerts said. Higher interest rates will not directly solve these problems. So it's naive to expect inflation to slow down immediately. Higher interest rates won't allow that, and when the energy crisis is over, inflation will continue. That way, lower interest rates will. High interest rates can play a role. It shows that central banks are aware of inflation, the extent of the problem, and are doing everything they can to bring inflation back to the 2% target as soon as possible. Dainis Gaspuitis, an economist at SEB Bank, said economic growth is slowing down right now, the problem is only getting worse and the peak has not yet come. In this case, raising interest rates would further complicate the situation, which is not optimistic, and will naturally increase costs for households and businesses. The question is, what are the alternatives? Currently, what are the drivers? Inflation in Europe is basically gas prices and developments in Ukraine. It is clear that the central bank does not have the tools and the leverage, said Gaspuitis. Higher rates mean monthly credit payments will increase for businesses and households, and some customers may find it difficult to keep up with the increased costs. Obviously, if utility and food prices are rising, making payments on credit can be a very difficult challenge.